QuickBooks Online 2025. Make loan payments, breaking out the interest and principal portions, tying the loan balance into the amortization table. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 Project 5. We set up in a prior presentation, opening up the major financial statement reports. Reports located on the left-hand side. We're in the standard reports tab, looking at the favorites section. Right-click it on the balance sheet to open a link in a new tab. Right-click it on the profit and loss, otherwise known as the income statement, also opening a link in a new tab. Let's go to that middle tab, closing up the hamburger. We're in the modern view mode. This time, instead of just looking at the month of January, I want to be able to see both January and February side by side as we now construct the data input for the second month of operations, the month of February. To do that, we'll select the drop down and we want to pick up the custom dates. I'm going to be going from the range of 010125. That's the same, but then we're going to 022825 and then tab. And then to get the month by month breakout under the modern view mode, I'm going to go under the display, and then within this drop down, I want to look, there's another drop down here, transaction date, and that's where you get your dates. I want to see it in the terms of months, which should give us that side by side. I'm going to then close this up. There's January and February of 2025 side by side. Let's go to the tab to the right and repeat the process. Closing the ham boogie. Changing the range, this time for a 2-month time frame, going from 010125, 022825, and then I'm going to go into the display button, select the drop down, select the next drop down, transaction date to see it in months, and close that out. Now notice, on the profit and loss, what we have is January, February, and then the total, because this is a timing statement, whereas when I go to the balance sheet, all we see is January and February because we're not totaling these up. These are as of a point in time. Let's close up the carrots while we're at it here. Closing up the carrot. Go to the tab to the right and close up the carrot. All right, let's go back to the balance sheet again. And we've been working on our loan payable last time, creating an amortization table. So now we're going to imagine we're going to do the data input for the loan payable. Now remember, the multiple problems with loan payable. 1, putting it on the books. So we talked about that last time. We'll talk about it more when we get to the adjusting entries, another course or section. 2, breaking out the short-term or long-term portion, which we talked about last time. The general idea being I would recommend putting it in one account, breaking them out periodically at the end of the period. And then number 3, what if I have multiple loan accounts? Do I put them in one account or multiple accounts? I would recommend you put them in multiple accounts per loan, possibly under a sub-account. And then 4, what about the fact that we have to break out the interest and principal when making loan payments? That's what we're going to be working on this time. That's the particular problem related to loans that we're on at this point in time. Now remember, 2 ways that you can approach this problem. The problem being, if I go to the amortization table, when I make a loan payment on a normal installment loan, a loan similar to what you might be familiar with a mortgage payment or a car payment, they typically make the payment the same on a monthly basis, but the breakout of the interest and principal is not the same. So the problem is, there's a couple problems. One problem is I might not have the amortization table because they might not give it to me. They just might tell me the amount that I pay them and then give me like the terms. They might not give me the interest rate because maybe they're trying to hide it. So I might have to create the amortization table, which we did last time, or possibly you can have your CPA firm help you out with that. Once we have the amortization table, then the question is, do I want to be breaking out the loan payments to tie out every time we make a payment to the amortization table, or do I want to make the transaction as easy and automated as possible, which means maybe I just skip recording the interest as I make the payments so that I can automate the payment that comes through the bank feeds as easy as possible, just recording it to a reduction of the loan payable. And then at the end of the year, I will use my amortization table to then break out the proper portion of interest and principal one time a year instead of doing it every time I make a payment. So we're going to do the first of those two options. We're going to try to make our payments correct every time we make a payment, which means I can't just simply automate the payment through the bank feeds, because although the payment's going to be the same, I can't automate exactly what the interest and principal will be each time, because you can see they change. Let me show you what I mean. I'm gonna highlight this one first, just to show that that's the one we're on. And let's imagine that we're going to make this payment. Now, in practice, of course, what we would typically do, go into the first tab, is this would be one that we could standardize typically with the bank feeds. So if you have the bank feeds up and running, you can go to the transactions and it would come through the bank transactions over here. And then we can assign the other side to the proper accounts of interest and principal. What we can't do is make a rule, a general rule, automating the transaction to be entered very easily if we have the breakout of interest and principal that will differ. Now, as we make the payment, of course, what kind of form is that going to be? It's going to be either a check form or expense form. So let's do that. So we're going to do it this way. We're going to hit the drop down and we're going to say, is this a normal transaction that happens every period? Kind of, because it happens monthly, but it's a loan payment, which we don't typically think of as part of the normal customary cycles, customer cycle, vendor cycle, and payroll. So the next question, is cash affected? Cash is affected. So what form should I use? The form that decreases cash, which is in general terms a check form. Most likely we're not writing physical checks, but doing an electronic transfer. Therefore, we'll use the expense form, which is the same as a check form with no check number for electronic transfers. This being the form created when you pay for something with the bank feeds, for example. All right, let's go into that. Let's say we're going to pay Chase. We're just going to imagine Chase is our bank. We're going to set Chase up as a vendor, even though the bank doesn't really qualify for either a vendor or a customer, because it's kind of like the bank, but we have to pick one or the other. We'll choose the vendor in this case, and then it's going to come out of the checking account. Let's say we do the first payment on 02/01/25. And then the payment method that we're going to make is, we'll say it's an electronic transfer. I won't add it here. Let's say transfer store. You could add another. Let me add one. Let's say it's a transfer, for example. Save it. And so there it is. So boom, 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 boom. All right. And then on the category, so notice what we have here. How am I going to enter this? It didn't tell me to enter the cash in this format. In the desktop format, it tells us it has a field to enter the cash portion. But what we're going to do here is we're going to enter the other side of the transaction, which is usually only one account. But in this case, it's two accounts, which will add up to the amount that's going to decrease in cash, meaning we're basically making a journal entry. So there's two accounts that will be impacted, the reduction to the loan and the interest. So let's go back on over here and I'm going to say, all right, the two accounts are going to be the loan payable. So we have the loan payable, boom, and it's going to go down. We might put a description like first payment, or something like that, for the amount, how much of 1058.73. So it's going to say 1058.73. We're not going to make it billable or anything like that. And we have interest. Now let's see, we haven't set up an interest account yet. They call it interest paid. I don't like that name as much. I'd rather call it interest expense, but I'm not going to make another account called interest expense. I'm going to use what QuickBooks gives me and then possibly go in there and change it. So I'm going to say interest paid. We'll pick that up, and that's for the amount of $300. So 300, and then that's going to give me a total. So what's going to be the decrease? I'm going to close this up to the checking account, $1,358.73. So you can see how this works. In the online version, we don't actually do the data input for the reduction of the cash. We do the data input for the other account that's impacted, which oftentimes is just one other account, which will equate or be equivalent to the reduction to cash. But if there's more than one account, then we basically put the other side of the transaction, and the reduction to cash is the plug. It's the thing that's going to be calculated in order to make the journal entry correct. So what's this going to do? It's going to decrease the checking account by 1,358.73, which should match this. And then it's going to decrease the loan payable, a liability account, by the 1,058.73, repaying the principal portion of the loan. But we also have the interest portion of the loan, which should be on the income statement as an expense type of account. Let's save it and close it and check it out. Save it and close it. We're going to go to the balance sheet and refresh it. Where's the refresh button? I have to go into here to refresh it. Caret, then refresh. Close the caret. Okay. So then we have the loan payable. Donde. It's in, let's go into the February one so you can see the two numbers have changed from January to February due to the payment made. There's the expense type document, the 1,058.73 being the portion for the principal reduction. Back to the reports. Let's go to the profit and loss for the other side, opening the caret so I can refresh and then close the caret. And scrolling down, there's the $300 here. That's for the interest portion of the loan. It's in a general expense account. Now, there's also a question that sometimes you might want to put the expense account into like an other expense that we might play with possibly in a future presentation. And the reason you might do that is because what you would like to have down here is, in essence, your net income. But you would like your net income to be something that you can budget for going forward. So the interest charges, although they might still be there in the following year, aren't really part of your normal operations. In other words, if you didn't have to finance the equipment, then you wouldn't have to pay interest expense. It's not part of your normal operating expense in that sense. So that means that you might want to have your operating income that doesn't include financing charges and then have another subtotal underneath it for the financing charges and also charges that aren't likely to happen on a routine basis. And right, because that gives you a better understanding of how you're performing without taking into account financing charges or charges that you don't expect to be repeating in the future, and then add those charges at the bottom. So we'll kind of toy with that later. But for now, let's enter another payment as of the end of the year. Oh, I didn't check out the cash account. Let's go back on over here in the checking account. Let's go into the checking account. That should be the first one I should have looked at. There it is, the expense account here for the full amount of the payment. All right, let's enter another payment. Let's imagine that we're at the end of the month. Now I'm going to enter it as of February 28th so that we have two payments in the same month, but it's about a month later. And I want to put it in the same month so we can see it in the same transaction detail report. So let's imagine a month passes and we're making the second payment. So let's go back on over here. I'm going to say plus once again, go into the expense form. We're going to say it's for Chase. We're paying Chase again. Imagining a month has passed, I'm going to make it 02/28/25, the end of the month. And then it'll be an electronic transfer, let's say. And then down here, notice it tries to memorize. That's great. So now QuickBooks is saying, hey, look, this is what you did last time. So that's good. But notice, although the balance here is the same, if I go to the second payment, let's say this one, let's go ahead and make this back to blue and then make this one yellow. That's the one. Let's make it green. That's the one we're on now, the green one. So the payment's the same, 1,358.73, but now the interest and principal should be different. That's the problem. We want to point out the payment's the same, but if I automate this transaction, if I was to save it, if I was to make this the rule that we put into the bank feeds, for example, like breaking up these two accounts, then that's not going to work because my interest and principal still won't match out to the amortization table. So that is why I have to, even if I had to automate this, I'd have to go in here and then change it, and be like, okay, now The principal is 106314, 1063.14, and then the principal, and then the interest is 295.59, 295.59 now, and that should come out to 135873. 135873. So the balance is the same, but this two breaks out. That's kind of a pain to do because that means I have to, even if I'm trying to automate my system with the bank feeds, pull out the amortization table and properly break out these other two accounts every time I make the data input, which I don't want to do. I want to automate it. So how could I automate it? How could I not have to do that? Well, I can just eliminate the interest and post everything to the loan payable, which is wrong, but will work for our adjusting entry purposes if at the end of the year, either ourselves or the CPA firm or tax preparer will then pick up the amortization table, create it if necessary, and break out the proper portion of interest and principal periodically to get the tax return correct and possibly for external reporting needs. If you need a loan or if you're given the financial statements to investors or whatever, right? So that's going to be the idea. So let's go ahead and save it and close it, and then we'll check that out. Go into the balance sheet, and then the caret is open, so I'm going to refresh it, and then I'm going to close the caret, and then I'm going to go into the checking account to check out the check-in, and if I scroll down, this is for January. Let's go back. Every time I go back, it opens the caret back up. That's interesting. Let's go into the February one. And so in the February one, now you can see the two amounts are the same for the checking account. That's great. Let's go back. But if I go to the loan payable portion, loan payable, and I go into the February balance, you see the two amounts are different, even though I'm paying off the same loan because of the amortization table structure. Let's go back. Let's go to the P to the L, the profit to the loss, open up the caret to refresh, and then I'll just leave the caret open since it opens up every time anyways. I'll just leave it that way if that's how you're going to be. Then we're going to go into the interest, and now, of course, the interest portion here also changes. So as time passes, what happens is you make the same loan payment, but the amount allocated to interest goes down, as you can see, over time, and the amount allocated to principal goes up, as you might have experienced with your mortgage payments, which is good, but also complicates things because you might be able to get a deduction for the interest. So when you're trying to budget what your deductions will be over the life of the loan, it becomes an issue because although the loan payment is the same, the amount that you get to deduct for taxes is not. But we won't get into that right now. Let's go back. All right, so that's going to be the general idea. Let's go into that first tab again, just to see where that interest payment was located in the transactions and the chart of accounts. Closing up the hamburger. This is the chart of accounts provided to us by QuickBooks, and we've been using the accounts if they fit it to our needs. And I'm just going to scroll down. I'm looking at the expense section now. I'm going to go to the next set of accounts. Here's the interest paid. So notice they have a parent account of interest paid and then loan interest, credit card, and mortgage interest. So we just use the parent account here. And if we wanted to change the name, which we might do in the future, to interest expense, I can change it here. And then I also might change kind of the location of it to put it into other assets. So in other words, if I go to this income statement, we might put it down into other just to get an idea of what that would look like if you put it into other at the bottom. So we will play with that possibly later. But for now, this is where we stand, people. This is our balance sheet. As of now, assets. It's really weird the way this report moves around in the modern view mode. I have to get used to it. I'm used to classic view. I'm more of a classic type person, but I'm going to get used to it because I need to be up to date on the most modern stuff. Let's go to the trial balance and check out our numbers there. trustee trial balance. I'm going to open up the ham boogie, back to the reports, close up the ham boogie, type in trustee trial balance, but not trustee, just trial balance. Even though we call it the trustee trial balance, don't type trustee because that's not going to be there. 010125 tab. Let's go let's try it 022825. And then let's see what would happen if I see it by month and run it. So this is interesting. And let me show you why. So we've got the 2 months. We're currently working on the month of February. So if your numbers tie out to my numbers, great. If they don't, you can see if your numbers tie out by the end of January, and then you can at least isolate the issue happened in February, right? And then you might want to increase the date range to see where the problem is. Now, the reason this is interesting, because this is the balance sheet on top of the income statement. The balance sheet has assets that go down to here, accumulated depreciation, the contra asset, liabilities from the accounts payable down to the payroll liabilities, and then equity from opening balance to owner's equity, which is equivalent to, in essence, retained earnings. And then notice what's happening on the income statement. You might say, hey, look, why is there an income statement in February? If I look at my income statement over here, in February, I only have one number in it. See, that's the issue on the trial balance. And the reason that is on the trial balance is because of the closing process. Because what happens on the closing process for a trial balance is that we take all of the like income statement accounts and we close them into equity. So in other words, if I go to the income statement, if I ran this report for 2026, this number would disappear and there'd be nothing here, right? Because it would close it out to the equity. And on the balance sheet, you can see here we've got the income statement, net income from the income statement. If I change the dates to 2026, that would roll into owner's equity, which would be equivalent to retained earnings. But QuickBooks does that automatically only on a yearly basis. So how in the world can they do that on a trial balance, which has both the balance sheet and income statement accounts? So what's happening here then, if I run it for this two-month period, the income statement is showing the year-to-date numbers, even though I'm running it for February. So the takeaway, and that's because the income statement accounts can't close out to retained earnings until the system does it automatically, which it doesn't do on a monthly basis. It only does it on a yearly basis. So typically when you're using like the trial balance, the takeaway from this is that you generally want to use the trial balance if you have something that you're doing for a year-to-date basis. I want to run the income statement year-to-date. If I want to run the income statement for one particular month in the middle of the year, the trial balance might not be the best report. But oftentimes that's what we want to do. We want to run the report, the trial balance for a year-to-date. So although this says February, this is kind of like the year-to-date of February. The income statement has not yet been closed out to the retained earnings is the general synopsis here. Okay, so if you want to just look at February only and compare your numbers, you can go to the income statement for February. That's the general idea. Okay.